time for the Property Podcast, where every week tens of thousands of property investors, new and experienced, join together to get news, knowledge and laughs at our expense. With me, Rob Bence.
And me, Rob Dix. Join us every Thursday morning for your weekly dose of property ideas and motivation. Then head over to our website at thepropertypodcast.com to keep the conversation going. Now though, let's get started.
Hello and welcome to the Property Podcast. It's episode 29. I'm Rob Bence. And with me every week is the delightful Rob Dix. Hello, Rob. How are you?
Good morning, Rob. Really well, thank you. And this week, we're going to be making our attempt at balance. So come episode 29, we're going to be talking about not buying a property directly and other ways to profit from the housing boom, which is supposedly coming our way. So we're going to be giving you a range of ideas about other ways to get involved in property. We've also got one of our weirder news stories to date. And of course, another resource of the week if you stick around to the end. So all that coming up.
It says something when one of our news stories is weirder than normal.
That's true.
But before we get going, thank you very much to the following outstanding, excellent people who've left us very generous reviews. First of all, Simi says, awesome is all I can say. 5 stars. Concise, but I like it. Thank you, Simi. Chris in Glasgow says, excellent. This is the first time I felt compelled to write a review. Thanks for the excellent podcast and all the practical advice. It offers real value. And H. Juan, or Huan, or I don't know if that's a nickname, but
I think people are doing it just to wind you up now.
Yeah, exactly. Great review, says, inspiring stuff. Having dabbled in the past, I wanted a real go at property now, and I wanted to find some proper advice. I couldn't have found a better resource. I wish I'd found it sooner. I listened to the entire back catalogue on a drive from Newcastle to Aberdeen and back, and now I'm absolutely infused. I also spoke to Rob Bence this week, which was fantastic to have my ideas looked at by someone with experience. If you like this podcast, try Property Geek as well, as there's some brilliant interviews. Well, 3 very different reviews, but all excellent. Thank you very, very much.
Yep, love that. And not only that, we've got another voice message this week. We're doing well on these.
We are. Please keep them coming. We love these. But this one's from Ken. So shall we take a listen?
Let's do it.
Hi guys, my name's Ken from Durham. I'm 63 with an inflation-proof government pension, but your podcast on inflation really made me think about my other investments. I have some which currently beat inflation, including a 5-year bond, which is RPI plus 0.5% tax-free, and share dividends, but I have a cash ISA currently paying 4.1%, which matures next May, and no current ISAs are anywhere near that. Your neatly explained conspiracy theory re government allowing inflation to erode debt and good debt, i.e. property used as a tool to bleed inflation, really made me think about what to do with the proceeds of that ISA next May. After 6 years of no mortgage and feeling pretty smug, I may just have to dip in my toe back into the property water. Well guys, at least I'll have your expertise to fall back on. Cheers. Great podcast.
Thank you very much, Ken. That's fantastic feedback. And I'm glad you liked the inflation episode. It seems it's been a really popular one, that one, Rob.
Yeah, I've had a few people say that they've enjoyed that, and I take that as a badge of pride that we've taken what's supposed to be such a dry topic and seemingly made it a bit more accessible. But yeah, thank you so much, Ken, for that message. It's great to get other people's voices on the show rather than ours. If you've got any feedback or any questions about anything at all, do just leave us a message. It's thepropertypodcast.com. You'll see a little button over on the left-hand side, and you can just talk straight into your computer and it'll magically be sent over to us. So give it a try. We should move on, though. So tell us quickly what you've been up to, Rob.
Well, okay, 2 things. First of all, thank you to everyone who started replying to the opening at RMP Property, the 2 or 3 openings that we have. If you missed out a couple of weeks ago, RMP Property is looking to take on outstanding, talented, super duper people. If you are a super duper person or you know a super duper person, then please get them to come to rmpproperty.com/property investment jobs. Really exciting role. I've talked about it 2 weeks ago, so I'm not going to say any more now, but you'll find more on the website. But great opportunity. Please go along. And because we record this, Rob, in the past, we obviously live our lives before we hear the final broadcast. So as we record this, I'm an unmarried man and I haven't been on my honeymoon. But when it's broadcast, I will be married and I would have gone on my honeymoon. So it's a weird one because when you listen, you may say, oh, congratulations, because I'm about to get married. But actually, when you listen, I have got married, just to make things weird.
So at the point of people listening to this, you could well be on a beach somewhere. This time warp that we record in really confuses the hell out of me, but let's say congratulations now. Whenever you've done it, it's a huge milestone, huge achievement. So all the best from all our listeners.
Thank you, Rob. Thank you very, very much. What have you been up to?
Well, just a quick one from me, a bit of a good news story in that I've checked out the best tenants ever this week. So I'm sad to be losing them, but I just wanted to kind of say that there are good tenants out there. You hear a lot of bad news stories. You tend to hear more about the bad than the good, which makes sense because the bad is so bad. But there are good tenants. These ones have been an absolute pleasure. They've left the place absolutely ridiculously immaculate, exactly as they got it. You'd never know they'd been there. And so I just wanted to share the fact that tenants are not all bad, whatever you read in the press. If you get good ones, treasure them because they're not all like that. So I've written them a glowing reference and hopefully they've moved on to somewhere else equally nice. So just wanted to share the positivity.
I think that's fantastic, Rob, because it's true. People jump on forums and talk about how things are terrible and bad, but you don't really think, oh, that was a nice tenant. I'll go and write about it on a forum, or my rent keeps coming in every month, no problems at all. It's not the normal thing you would do, but I think it's good that you share it because actually, I've been very fortunate with my tenants as well. And it's good to hear you have. And, you can run a portfolio and not have too many headaches. Sometimes things may go wrong, but for the majority of the time, if you set things up right, which is what we try and talk about all the time, then you should most of the time have good tenants who give you no problems at all.
When I'm next having a bad experience, I have to listen back to this segment to remind myself that it's not always like that.
Exactly.
Okay, well, let's move on to the news then. And this one's yours.
After your tanning one, I thought I have to up the stakes on the ridiculousness of the articles. Grand Theft Auto is a computer game. Not one that I've ever played, any version of it. But there is a new one called Grand Theft Auto 5. Now, I wish I had the time to play computer games, but I don't. And I probably, even in my spare time, I'd choose reading or other stuff over it. It may sound like a bore, but there we go. However, I do hear it in the news when I'm in the car or wherever. Lots of people are talking about it. So this is a cracker, Rob. Someone's put a property buying guide for Grand Theft Auto 5. So apparently you can buy property in Grand Theft Auto 5. And someone's taken the time to write a blog on a guide to buying properties on the game.
That's amazing. What can we pick up then in the game? Is it just all sort of your standard 3-bed terrace?
Oh no, Rob, no, that would be boring. You can buy cinemas, golf clubs, tequila bars. You've got garages where you can do dodgy things there, hangars, some things I can't mention because this is a clean show. It's crazy what the stuff you can buy. So if you're not struggling in real life to invest in property and feel like you'll never get there, then try Grand Theft Auto. You can build an absolute empire.
It sounds a lot more fun than the stuff I've been looking at recently. Maybe we should give computer games a try.
Yeah, I don't own any cinemas.
Interesting. I've not played Grand Theft Auto since the original Grand Theft Auto 1, which was a very different thing. But yeah, maybe a virtual empire is something to take a look at. Maybe if you get bored on your honeymoon.
I think the marriage won't last very long if I start playing computer games. But anyway, let's move on to our topic of the week.
So the topic of the week is about 5 ways to profit from a housing boom without buying a property. So the media is all about a coming boom in house prices to do with the Help to Buy scheme and the economy sorting itself out and all that kind of thing. Is that going to happen? We don't really know. Is house prices going up a good thing or a bad thing? Not really relevant, but people are saying that a boom is coming. And if you believe that that's true, there are some ways that you can get exposure to that upside without actually buying a property yourself. Maybe despite our best efforts for the last 6 months, you're still not convinced that buying a property is worthwhile. Or maybe you just don't have the cash right now or don't have the time right now or whatever. So we're just going to explore some different alternatives so you can get some exposure to that property upside without actually owning a property directly yourself. And for the basis of this, we're going to be using a Telegraph article, which we'll link to in the show notes. We're going to be taking the points from there. We're basically leeching off their research, and we're just going to talk about the points that they made. So we've got 5 different ideas for you. And the first one of those, Rob, is tracker funds.
It is a tracker fund, but it's a bit different. This one's completely new on me. They call it a houser. Okay, so think ISA, houser. I have to admit, I'm in property day in, day out, and I hadn't come across this until we started putting this episode together. And it is quite interesting because, think of your ISAs, they're not really doing much at the moment, 2%. If you're doing a normal cash ISA. So this one's a little bit different. And what they do is they say they track the Halifax price index. So they track it. And if the price index goes up, say 2%, you get the 2% return to you plus a bit extra. So let me explain. So if you lock in for a 3-year ISA, whatever the Halifax Price Index does over 3 years, they'll return to you plus 25% on top. So if year 1, it rose 4%, they give you an extra percent. Year 2, if it was the same, 4%, they give you an extra percent. And then say year 3, the boom kicked in and it was 8%, they give you an extra 2%. Now, I have to say, first of all, I'm not a financial advisor, and neither is Rob. So this is not advice. We're just telling you what the products are out there. And 2, they also work the opposite way. So if house prices fall, you have to take that hit plus a bit on top as well. So you have to be confident that in the short term, property prices are going to rise. So it is a bit of a gamble. There's a 3-year, a 5-year, and a 10-year product. The longer the product, the more potentially you can earn and lose. But it's quite interesting. I've not allocated my ISA this year, Rob, so far. And it's certainly one I'm going to take a look at because, I do feel there's going to be some growth over the next few years. What I would say is I'm not making that a recommendation you should, because I've only started looking at this last few days. I don't know the history of the company. It looks pretty new. They say they're new. So if there's a no track record, then that's not always encouraging. But there's some big names backing the scheme as well. So what I'd say is, if you're not using your ISA allowance because you're just fed up with the returns, this might prompt you to take a second look. It's certainly worth investigating. I'll say that much.
Yeah, it's a really interesting idea. And it seems like they make their money. They take your deposits and they lend that to homeowners and take an equity stake, which is why they make that margin, which they're able to pass on. Again, I don't really know anything about it at all. Tread with caution, but worth having a little look at. It's an interesting idea, at least. The next one that we've got for you is a more traditional one. This is residential property funds. Most funds you get are based on commercial property, but there are a few that invest in residential property. So an example of one is TM Hearthstone has got a UK residential property fund, and they buy houses, flats and bungalows, and they rent them privately to tenants like you or I would, or they do them as corporate lets, and they make their returns from the capital growth and the rents just like we would. So in theory, rather than building up your own portfolio, you can just invest in that fund and get a slice of the returns that fund makes. Therefore, if you think that rents are going to remain strong and prices are going to go up, you can get a slice of that by buying into this fund. However, there is what I consider a pretty major problem with this, which is a problem that you get with all actively managed funds. You've got a fund that people are in charge of. Those people need to be paid their wages, and there are the expenses of running the whole thing and everything else. So there are always fees that have to come out of the returns that the fund makes before you get your share. However, in this case, there is a massive fee. What they call the total expense ratio is 2.7%. So that means that the market needs to rise by 2.7% every year just for you to break even. So that's a pretty big gap. There's also a 4% gap between the price that they'll buy and sell at. So the market needs to go up another 4% by the time you sell just to break even. Although it's completely hands-off and you can get a piece of something which people who supposedly know what they're doing are already taking care of, you don't have to do anything. And you can get involved with less money than it would if you were buying your own house. Those are some big old fees. And so while you would assume that the market would go up more than that over time, you are losing a big chunk of your profits. So to summarize, that's one that is very directly linked to the market. So if you think that the prices are going to go up, that would be an obvious thing to get involved with, but you have to keep an eye on those fees. So you're kind of paying a price for your lack of involvement there.
So following on from that is the more traditional property fund that most people will be familiar with, and they're commercial property funds. So a lot of the points apply to what Rob said before. However, what I would say is there's a lot more choice. So therefore, the competition will bring the fees down slightly because there's a lot more competition out there for people trying to attract your money. Now, commercial property has taken a far bigger hit than residential property since the credit crunch, for obvious reasons. People spend less money, so businesses go out of business, etc., etc. So, it's easy to see why that's hit. A lot of people are now saying that it's bottomed out, and there's value there. I'm not qualified to say because I'm not an expert in commercial property. Residential property is my bag. Commercial property, I know probably more than the average person, but I can't say, and I'm unwilling to say whether that's true or not. You have to do your own research. If that's the case, then there's an argument that there's potential for some uplift in the future. The same things apply. There are fees. in all these products that you have to take into account and look into it to see how much uplift you need before you start making any real money. But generally, it's good for diversification. It's worth looking at, if you want to spread your risk. But commercial property, I don't know. I think it's far more vulnerable to the general economy than residential property, because shops being open is, nice, but not essential. Having shelter, a place to live, is a basic human need. And that's why I personally stick to residential property. But if commercial property interests you, then that fund might be worth taking a look at. And we'll link in the show notes to a few different suppliers.
Okay, so number 4, we're moving away a little bit from the funds and we're moving into talking about shares in individual companies. And so number 4 is shares in house builders. So this one makes obvious sense. If property prices are going to rise, then the valuation of companies whose activities are related to property will rise. So house builders include Taylor Wimpey, Persimmon and Barratt as obvious examples. House builders suffered hugely in the credit crunch. They absolutely tanked. And since 2008, they've actually come back quite a long way. But because they fell so far, they could very well still be good value, because they've basically had a few years to get their house in order, but property prices haven't moved on in any significant way. So their years of big profit could be still to come for these house builders. I'm not an expert in shares or corporate financing or anything else. I don't understand this in any great detail. But in the Telegraph article, Richard Watts from Old Mutual says that if house prices go up by 1%, that could increase the profitability of a house builder by 5 to 7%. If you see the projections for what house prices are supposedly going to be doing over the next 5 years, then multiply that by 5 and you can see what prospects there could be ahead for house builders, especially again if there's a public appetite for getting houses built, which we've talked before about how slow the UK has been to build new houses. So it makes sense that if you think that there's going to be a housing boom, a way of getting access to that is going to be to buy shares directly in house builders. Although, of course, something to be aware of there is that you don't have a lot of diversification, especially if you're just buying into one company. They could have some kind of terrible mismanagement, or they could get everything wrong or overextend themselves in some way, and they could end up having a really bad time, even though the economy and house building as a whole is doing well. So that's something to be aware of. But shares in house builders could well be worth a look.
I mean, Richard Watts' probably point is correct, but what I would say with most companies on the stock market, builders included, if there's enthusiasm for the market, which there is with property at the moment, then they often price into the immediate expected growth into the share price already. So it's already priced in. So it's something to be aware of. So listeners, if you're new to shares, don't think that, if the property market goes up over the next 6 months, then my shares are necessarily going to go up, because it may already be priced in. And actually, it may go up, but if it doesn't go up as much as expected, then your share prices could actually fall. I know it sounds strange if the property market rises, but it's like when a company makes huge profits. But if they weren't as big as they were expected to be, then the share price can fall. It's the same with property. If they were expecting a 7% rise and it only rose by 5%, then the chances are the shares may fall slightly. That's not advice. It's just my personal opinion. Speak to an advisor if you're going to look at things like that. But just be careful. And this really links into our last one, the 5th one, which is shares in companies that will benefit from increased activity in the property market. So an interesting one. Clearly, you can go directly to the builders, but there are other companies that will benefit from an uplift in property prices. That may be mortgage companies that offer mortgages, or it could be companies that are to do with construction and, of building of houses like Tops Tiles or Howdens. It could be estate agents like Countrywide or storage companies like Big Yellow. Think about it. There's lots of companies that are linked to the success of property and also the failure. It goes both ways. And if property tanked, those companies would suffer. It's worth looking at if shares are something that interests you, not just at the property developers themselves, but also the companies that will benefit from a general uplift. Rob's covered a lot, so I'm not going to add too much more to that, but it's just a way of adding a little bit of diversification again to your portfolio.
To wrap this up, I think diversification is the word here, because if you believe in the property sector in the medium to long term, by doing some of the things that we've talked about, that is a way that you can profit from any growth that is to come with your risk spread further than if you just had one property. So if you've got one property or even 3 or 5, then you could get really, really unlucky with the particular properties that you've bought, have lots of unexpected expenses or whatever, and you could end up not making as much money as you thought. But that's not going to be the case if you've diversified across a wider range of companies and assets within the overall broad property sector. Diversification is a major benefit of what we've talked about. The major disadvantage is lack of leverage. And we've talked about leverage a lot before. We had a whole episode showing you how it magnifies the returns that you can make and how it's one of the best things about property investment. You're not going to get anyone lending you money to buy shares. While you can get, in theory, some decent returns from these, but when you look at the return on investment that you can get on buying your own property, if you use leverage, that is going to dwarf the returns that you can get from some of the things that we've talked about. Diversification is a big benefit. Lack of leverage is the main disadvantage. Also, though, Rob, we talked about this before the show. We were talking about whether we were tempted by any of this, and we kind of decided that we'd be sticking to what we know, because you do get so much more control when you're actually investing yourself. Otherwise, you are just kind of giving your money to someone else and hoping that they do the right thing with it.
Absolutely. That's the big one for me. It's lack of control. So the funds, you've got to trust the people who you're paying handsomely to buy the right properties in the right areas. How do you know that they're good at what they do? Shares. The market could be doing well, but if the person in charge of the company is poorly running it, then they may underperform to what the market expects them to do. They may exceed as well. It can flip both ways, but it's just that lack of control. You don't know. You've got to put faith in people that you have no personal relationship with. So for me, lack of leverage, massive, and lack of control as well. I know what I'm doing with my portfolio. I make the decisions. I take the hit if things go wrong, but at least I've made the call on everything I do.
They are 5 ways to profit from a housing boom. If you've got any other suggestions, then let us know. If you've got any thoughts about any of the things that we talked about, then tell us. You can leave us a message, as Ken did earlier, or you can leave us a comment on the show notes, which you'll find at thepropertypodcast.com. We'd love to hear what you have to think about it.
Fantastic. Okay. So the resource of the week, Rob, is one that I used to use, but you use regularly still.
We've covered similar things before. It's to do with grabbing things that you want to read around the internet and saving them for later when it's more convenient for you. We've talked about a few of them before, but this is just another one because I sort of went through a few before I found the one that suited me. And this one is Instapaper. You'll find it at instapaper.com, and we'll link to it, of course. It's similar to some of the other things we've talked about. You get a little bookmarklet, which you can put in your browser. And then when you find an article that you want to read, but you don't have time for right now, just click it and it'll save it for you for later. And there are apps. And so you can then get that synchronized across any devices you use, whether that's your iPad or your Android phone or whatever. And it just means that when you're trying to get some work done and you see a link to something that looks really interesting, you don't have to distract yourself by reading it all straight away because you're worried you're going to lose it, or emailing it to yourself or any of that kind of thing. You can just save it to Instapaper and take a look at it later. The reason I mention it now is it's just gone through a big redesign. It used to be a little bit ugly and hard to use, but they've just redesigned it. They've redesigned all the apps. It's well worth a look if you haven't got involved with a similar thing that we've talked about already.
I might have to go back and take a second look because, I remember getting a little frustrated with it. What I do is actually use Evernote, an app we talked about right at the beginning of the podcast in one of the first episodes. And in Evernote, you can put categories that you can list. And I use the website clipper tool. So when you're on the internet, there's a little clipper button. If I see an article I want to read later, I clip it and put it in my catch-up category. And then later on, I'll pick up my iPad, go into Evernote and go through all my articles I wanted to catch up. Probably a little basic, and Instapaper probably has a few more bells and whistles. But if you're a fan of Evernote and you're using it already, then maybe you can consider that approach.
Yeah, and Evernote's just upgraded their web clipper as well. I don't know if you've seen it yet, but they've just had loads of extra features and you can annotate the things that you clip. And that's really nice as well. So if you haven't got involved with Evernote yet, what's wrong with you? It's amazing. We're both obsessed with it and it's just got even better. So give it a try and it's free.
Super. Okay, Rob. Well, I'm glad we did this episode because, we love what we do, but it's good to give people options and give them a bit of knowledge on a different approach. Next week's episode is one that has been in serious demand. I think every probably, second or third request for an episode is this one. and it's tax.
Which makes sense, because you're going to all this effort to get your properties together and go through everything, and then you have to give all this money away as tax. And you obviously want to give away as little tax as you legally can. We've sort of deflected a lot of these questions because we're not experts. It's not our thing. So much like we did with when we had our episode on mortgages, we got an expert, Lisa Orman, to teach us about that so we could talk to you about it. We're doing the same thing with tax. So we've got a chartered accountant called Ian Wallace to come in. I've spoken to him before for the Property Geek podcast, but he's agreed to write an article for us, which is going to be going up on thepropertypodcast.com. And we're going to be using that article as the basis for our conversation next week. And so we asked him a lot of the questions that you've been asking us. He's going to give us the answers, and then we'll be chatting them through next week. So if you've got any questions about tax, or if we've given you an unsatisfactory response about tax in the past, this will be the episode to listen to, because we'll be getting all the answers right from someone who actually knows what they're talking about.
That's us for another week. Thank you very much for listening. We will be with you next Thursday. The wedding won't interrupt things, but as for me, I'm off to get married.
We'll see you next week.
Bye-bye.
Thanks for listening to The Property Podcast. Make sure you join our mailing list at thepropertypodcast.com.
And remember, we love 5-star reviews. Rob even loves them more than air miles.